Trump personally announced on social media that the US-Iran ceasefire agreement is basically settled. This is not a rumor or media speculation. It is Trump himself who said it. The Iranian Foreign Ministry confirmed it synchronously. Both sides are making the final finishing touches on a memorandum of understanding covering 14 items. U.S. Secretary of State Rubio hinted that there will be a major announcement within a few days. This war that put global supply chains and the Middle East powder keg on the fire and tested us for nearly 3 months is rapidly coming to an end. The whole internet is shouting one sentence now: it is over. The demand for geopolitical hedging is receding. Gold is going to plummet, but if you dig down, actually the vast majority of people are stuck in an extremely fatal cognitive blind spot. If your current intuition is also following the panic selling of gold, then you are preparing to hand over the bloody chips in your hand to Wall Street. And the time window is very tight. On Thursday, the U.S. will release PCE inflation data. In the same week, the ceasefire negotiation enters the final sprint stage. Do not let these two things happen in the same week. It will be the most critical window for gold in the past few months. Welcome to Wall Street Outpost. Today, we are not talking about how the hedging sentiment fades. We are really dismantling the underlying pricing rules. First, why is the global situation clearly so chaotic? War's U.S. debt is high, and gold has been like stagnant water for these few months, unable to rise. Second, is the ceasefire a bearish factor for gold or a hidden major bullish factor ignored by the vast majority of people? Third, how will the US PCE inflation data, which is about to hit the market on Thursday, determine the life and death of gold? What preparation should we be making? Now let us get into the main topic. Let us flip that big stone over to look at it. In the past few months, gold has given the market an extremely strange feeling. The global situation is chaotic. The US-Iran war, the Middle East tension, the US debt is endless. But gold is just lukewarm. The trading volume is light, the direction is unclear, like stagnant water. Futures analyst Grady said a very vivid sentence: every rebound looks like a selling opportunity. Why is this? Most people give the explanation that the market is waiting and watching, sentiment is unstable, liquidity is insufficient. These are all superficial phenomena. The real reason is hidden in a set of numbers, and behind this set of numbers is a 3-level transmission chain that locks gold tightly. First, look at these two numbers. US April overall CPI, 3.8% core CPI for the same period, which is inflation excluding food and energy, 2.4%. The two numbers are different by a full percentage point. Where does this gap come from? It all comes from energy, all from oil prices. The Strait of Hormuz has been tense for a few months. Brent crude once broke through $105 per barrel. Oil prices soared. All consumption costs related to energy rose a circle from gas to electricity. From transportation to manufacturing, all were stuffed into the overall CPI. Let me give you an analogy to help you see this clearly. Core CPI is the foundation of your body, reflecting the structural inflation pressure of the economy. Now, 2.4% is actually not far from the Fed 2% target. But overall, CPI is wearing a thick oil price jacket on this foundation. Once the jacket is worn, the number went directly from 2.4% to 3.8%. The problem is that the market looks at the number of that jacket, 3.8%. Once this big number of 3.8% comes out, the market immediately begins to price in. The Fed does not dare to cut interest rates, and even begins to discuss interest rate hikes. Fed Governor Waller directly said, the next policy statement should clearly state that the possibility of interest rate cuts is no higher than interest rate hikes. The interest rate swap market entered the expectation of a 25 basis point hike before the end of the year for the first time. This is the first level of transmission. Oil prices high, overall CPI falsely high rate hike. Fear triggered. What about the second level of transmission? Gold is a non-interest bearing asset. You hold gold. It does not give you interest, does not give you dividends. When U.S. Treasury yields are rising, when the return on U.S. dollar deposits exceeds 5%, funds naturally withdraw from gold, which is something without interest, and flow to those dollar assets that can give you money. The second level of transmission, rate hike, fear, ignites non-U.S. debt yields to soar. The opportunity cost of holding gold explodes. The third level of transmission is the result you see. Gold is lying there dead, unable to move. Friends, do you see it clearly? Now, what has suppressed gold in the past few months is not the war. It is the oil price behind the war, the inflation numbers brought by oil prices, and the rate hike fear ignited by inflation numbers. As long as that thick jacket called oil price is still worn on the body, even if gold has a strong long-term logic, it can only lie there and pant. So what exactly does the ceasefire mean? Most people judge it like this: ceasefire, geopolitical risk reduced, hedging demand recedes, funds withdraw from gold, gold falls. This judgment holds true only under one premise. What is the main driver of gold's rise and fall now? Let me show you a fact. In the past few months, the US-Iran situation has been tense. Middle East smoke has not dissipated. Logically, geopolitical hedging demand should be very strong. But what about gold's performance? Trading volume is light. Direction is unclear. Every rebound is a selling opportunity. What does this indicate? It indicates that geopolitical conflict has long ceased to be the main engine of this round of gold trends. What really dominates gold is the three-level transmission chain we mentioned just now. It is oil prices, it is inflation expectations, it is the fear of non-interest bearing. So the real important impact of the ceasefire on gold is not the receding of hedging demand, that old path, but a deeper and more direct path. Ceasefire lands in the Strait of Hormuz, reopened the Middle East crude oil supply pressure, eased oil prices have a fundamental basis for systematic pullback. Once oil prices fall back, that thick jacket pressing on gold begins to fall off. The overall CPI begins to approach the core CPI once the overall CPI cools down. The market S pricing for Fed interest rate hikes begins to recede. Once the rate hike expectation recedes, U.S. Treasury yields follow down. Once US Treasury yields fall back, the opportunity cost of holding gold decreases. This is a key. Open three locks. The first lock, oil price. The Strait of Hormuz is the most important oil throat in the world. About 1/5 of global oil trade passes through here. The few months of tension in the Iran situation, the blockade panic of this shipping lane, contributed a huge premium to oil prices. Brent crude once broke through $105. A large part is this panic premium. When Trump announced the ceasefire, he specifically pointed out that the Strait of Hormuz will be opened. The meaning of this sentence is very direct. The panic premium begins to exit, of course. Iran's current negotiation position is that the war issue is discussed first. The nuclear issue and sanctions flow to the second stage, so Iran's oil exports will not be fully lifted overnight. The fall in oil prices is a gradual process, not a cliff-like collapse, but the direction is already clear. The war premium is exiting. The oil price center of gravity is moving down. The second lock, inflation expectation. Every 10% drop in oil prices, historical statistics will roughly drive the U.S. overall CPI down by 0.3 to 0.5 percentage points. The gap between the overall CPI and core CPI is roughly this magnitude. The 3rd of April, 0.8% vs 2.4%, a difference of more than a percentage point, almost all from energy. If oil prices fall back 15% to 20% from high levels, the overall CPI may move from 3.8% towards 3% or even lower. Once the chasm between the overall CPI and core CPI begins to narrow, the argument that the Fed needs to hike rates loses its most core data support. The third lock, rate hike expectation. This is the most direct variable currently suppressing gold. Once the argument of Waller that cutting rates is no more possible than hiking rates loses the support of inflation data, the market pricing for rate hikes has room to adjust again. The day when the rate hike expectation recedes is the day when gold is truly unlocked. Now, you should understand why the ceasefire is bullish for gold and not bearish for gold. If the ceasefire only takes away geopolitical hedging demand, then it is indeed bearish for gold. But if the ceasefire also takes away the panic premium of oil prices, the false fire of inflation expectations, and the suppression of the fear of non-interest bearing, it is a systematic major bullish for gold, and in the current macroeconomic cycle, the weight of the latter is far more than the former. After finishing the ceasefire, I want to take you to see a base card that is currently the most undervalued by the market. Kevin Warsh was officially sworn in as Fed chair on May 22. This is a person who makes the market extremely divided. We dismantled the line between him and gold in detail in our previous program. Today, I only say one thing that the market has not fully digested. Warsh policy framework emphasizes average inflation. Not mechanically reacting to single-month data, but observing the average inflation trend over a long period, he believes that monetary policy should not be kidnapped by short-term fluctuations, and should focus on the structural inflation path. This framework has an extremely important meaning in the current macroeconomic environment. Back to those two numbers, overall CPI 3.8%, core CPI 2.4%. If you only look at the single-month overall CPI 3.8%, of course, it is scary, completely without room for rate cuts. But if you stretch the time, look at the average trend of core inflation, the numbers are completely different. Core CPI has been slowly declining. Currently, it has fallen to 2.4%. Not far from the Fed's 2% target. What does Warsh's average inflation framework mean? It means as long as the downward trend of core inflation can be maintained, occasionally 1 month because of an oil price spike, leading to high overall CPI is not enough to constitute a reason for rate hikes, and will not really block the path of rate cuts. Let me give you an analogy. When your boss evaluates your performance, he does not spot check once a month, but looks at your average performance for the whole year. This month you asked for leave for a few days because of illness. The output was a little less. As long as the annual average is still within the target, your year-end bonus is still guaranteed. The current gold market is waiting for this new boss evaluation framework to be fully digested by the market. Once the market understands that Warsh will not easily turn hawkish because of 1 or 2 months of oil price impact, that overpriced rate hike expectation will begin to loosen, and at that time the pressure on gold will loosen together. This base card is the most undervalued by the market. There is another scenario you must know. At Warsh's inauguration ceremony, Trump first said to him to be completely independent, do not look at me or anyone else. And then just 2 minutes later, he began to say that the economy is strong and does not need to be cooled down and hopes the economy will be as prosperous as ever. This contradictory scene tells us one thing. The Fed's policy path is full of variables under political pressure, and this uncertainty itself is a crack in the statutory credit system. From a long-term perspective, it is a deep endorsement of gold's monetary attribute. Okay, after saying the structural logic, let's look at a very critical short-term fuse right in front of our eyes. On Thursday, the U.S. will release the core PCE price index for April as well as personal income and expenditure data, and the second revision of first quarter GDP. First, make it clear what PCE is and why it is more important than CPI. CPI is a fixed basket of goods, calculating the price changes of these goods every month.